Hi everyone, Jenna from The Profitable Agent joining you today. Today, I want to talk about something that comes up in almost every single conversation I have with realtors: deductions, write-offs, what you can claim, what you can't, and what you think you know that actually might be wrong. Because here's what 11 years of working exclusively with realtors has shown me. Most agents are operating with a mix of myths, half truths, and gaps in their knowledge that is quietly costing them money every single year. Some are claiming things they should not be. Others are leaving legitimate deductions on the table because they assumed they didn't qualify. And most don't know which category they're in. Today, I'm busting the 5 most common deduction myths I hear from realtors so you can stop guessing and start getting it right. This is the one that gets realtors into trouble most often. Yes, being self-employed gives you access to deductions that employees don't have. That's real, but it doesn't mean everything is fair game, okay? The CRA requires that expenses be reasonable, documented, and incurred for the purpose of earning income. That last part matters more than most people think. A business dinner with a client? Potentially deductible. Dinner with your spouse on a Friday night? Not deductible, even if you talked about work. The myth isn't that self-employed people can write things off. The myth is that the rules are looser than they actually are. I promise you they're not. They're just different. Self-employed doesn't mean self-exempt. The rules still apply. You just need to know what they actually are. This one surprises a lot of realtors. Yes, your vehicle is a legitimate business expense. You drive to showings, to client meetings, to the office. That use is deductible. But the deduction is based on the percentage of business use versus your personal use. And CRA expects you to be able to prove that with a split, ideally with a mileage log, mileage tracker, whatever that looks like for you. Most realtors aren't keeping one, and without it, you're either guessing, which creates risk, or you're underclaiming, which costs you money. The vehicle deduction is one of the most valuable ones available to realtors. It's also one of the most commonly done wrong. The deduction is real. The documentation requirement is equally real. You need both. I hear this one consistently, and it's costing realtors a legitimate deduction. Having access to a desk at your brokerage does not automatically disqualify your home office. What matters is whether you actually use a dedicated space in your home regularly and exclusively for work. For example, you guys can see here, I am in a home office or one of the bedrooms in my house. If you're doing your admin, your calls, your marketing, your follow-up from a home office, that space may very well qualify. The rules here are specific, and whether you qualify depends on your individual situation. But the assumption that the brokerage desk disqualifies you, that assumption alone has cost realtors real money. Don't, disqual- don't disqualify yourself based on a myth. Let the actual rules decide, okay? This is the myth that adds up the most. Realtors often focus on the big ticket items, the vehicle, the marketing, the campaigns, the staging costs, and ignore the smaller recurring expenses, the subscriptions, the office supplies, the professional development, the phone. Individually, they feel minor. Collectively, they can represent a significant deduction that most realtors aren't capturing. The reason they get missed isn't because realtors don't care. It's because there's no system to catch them. No habit, no process, no folder where receipts actually land. Typically, they go into a shoebox or maybe they end up on the floor of your car, right? The fix isn't complicated, but it doesn't have but it does have to be intentional. Oh, excuse me guys. The CRA doesn't round up on your behalf. Every dollar doesn't track a dollar you don't recover. I want to be careful how I say this because I'm not here to throw generalist accountants under the bus, but this is the myth that I see that can cause the most damage over time. A generalist accountant will file your taxes accurately based on the information you give them. What they often won't do is proactively look for the deductions specific to real estate income, flag the nuances in how commission-based income should be structured, or ask the right questions about your vehicle use, your home office, or your marketing spend. That's not a failure on their part, it's a specialization gap. Realtors who assume their accountant is optimizing their taxes when their accountant is simply filing them are often leaving hundreds or thousands of dollars on the table every single year without even knowing it. Accurate and optimized are not the same thing. You deserve both. 5 myths, and the thread running through all of them is the same thing I said in my last video. Nobody ever taught realtors this stuff. Not your broker, not your licensing course, not your generalist accountant. It falls through the crack year after year, and the cost is real. The good news, every single one of these is fixable. You don't have to keep guessing. You just have to get the right information and the right support. If you're watching this and wondering whether you've been getting this right, that's worth finding out. Book a 30-minute clarity call with me, and we'll look at your actual situation, walk through what you're claiming, what you're maybe missing, and what the opportunity looks like for you going forward. The link is in the description. And if this was useful, please share it with a realtor you know. I promise you they need this conversation too. Thank you guys so much for joining me today. Jennifer from The Profitable Agent out.